Every day, without anyone noticing, new money is created. Not slowly, not carefully, but constantly. While most people think money is printed in factories, the truth is that printing is almost irrelevant. Physical cash is only a tiny piece of the system. The vast majority of money exists digitally, and every single day, billions of dollars are added to the economy with a few keystrokes. This money doesn't come from nowhere by accident. It is created intentionally, built into the structure of modern finance, long before it ever reaches your bank account. Before money became numbers on a screen, it was built on trust. Thousands of years ago, trade didn't involve coins or paper. If a farmer needed a tool, he went to a craftsman and made a simple agreement. He took the tool and promised to repay the value later. That promise itself became the currency. As long as trust existed, the system worked. Over time, people looked for easier ways to trade and began using goods everyone needed, such as grain, salt, or livestock. These items had value because they were useful and difficult to obtain. Trade became faster and more balanced, but it was still inefficient. Carrying bulky goods over long distances made large-scale trade almost impossible. Eventually, societies turned to metals like gold and silver. They were rare, durable, and easy to transport. With metal coins, trade expanded across continents. Goods could now move between distant civilizations, connecting markets from Asia to Europe. But even this system had limits. Transporting large amounts of gold was dangerous and impractical. This problem quietly transformed the meaning of money itself. In early modern Europe, goldsmiths offered a solution. People deposited their gold for safekeeping and received paper receipts in return. These papers were promises that the gold could be reclaimed at any time. At first, the paper meant nothing on its own. But because it could be exchanged for gold, people began using the receipts directly in trade. The paper became money, even though it had no intrinsic value. Then came a critical realization. Goldsmiths noticed that most people never came back to reclaim their gold. So they began issuing more receipts than the gold they actually held. These extra notes were loans, created out of nothing, and lent with interest. No gold moved, yet new money entered the system. When the loan was repaid, the original amount disappeared, leaving only the interest as profit. With a single loan, the total amount of money in circulation increased, even though no new gold existed. As long as everyone didn't demand their gold at the same time, the illusion held. Replace goldsmiths with banks and paper notes with digital numbers, and you have today's financial system. Banks do not lend out existing money in the way most people imagine. When a bank issues a loan, it creates brand new money by typing numbers into an account. That money did not exist before. When the loan is paid back, the money is erased, but the interest remains. This process is the primary way money is created in modern economies. This constant creation of money allows economies to grow. Businesses expand. Workers are paid, technology advances, and trade accelerates. But there is a cost. If money grows faster than real goods and services, prices rise. Inflation is not caused by greed or chance, but by imbalance. Too much money chasing too few goods. Because of this, banks are supposed to limit how much money they create. In theory, they are constrained by reserves. In practice, those limits have largely disappeared. When banks need more backing, they turn to central banks. When governments need money, they borrow it by issuing bonds. These bonds are purchased by banks, corporations, and foreign nations. The government spends that borrowed money into the economy, where it eventually flows back into the banking system. But governments almost always spend more than they collect in taxes. To cover the gap, they issue more debt. New money enters the system, backed by future taxpayers, and the cycle continues. This is how the modern world runs. Money is created through debt, sustained by trust, and erased through repayment. It fuels growth, but it also quietly locks entire societies into perpetual obligation. The system isn't inherently evil, but it is fragile. And once you understand how money is really created, you begin to see the world differently. If this changed the way you think about money, leave a like to support the channel. Subscribe to the History Engine, and follow along as we uncover the hidden forces that shape the world you live in.